Remind us of your position. You're not wildly bullish, but you are more bullish than the average CNBC guest that we have on lately on stocks, right?
Yeah, that's correct. I think the street and our institutional investor clients have become outright bearish for understandable reasons because there's headwinds. And I think the one key difference we have is that we think a lot of bad news is priced in. And while the risks of recession are really elevated, I think there's some leading indicators that are telling us that in some ways, some of the worst of the inflation is behind us. And then if that's true, the Fed doesn't have to be potentially as aggressive as futures markets are pricing.
And yet yields continue to go up. I mentioned 275 on the 10-year. So if what you were saying is true, wouldn't we need that to stop for the NASDAQ and technology to work?
Well, actually, I'd say that if the long end was actually falling, I think that would point to elevated risk of recession. So the fact that long end rates are actually rising and the yield curve steepening in some ways is actually showing us that the narrative is probably shifting towards a growth scare, but that we're going to emerge out of this period. I don't know when we get clarity. And if that's the case, I mean, even a 3% 10-year, even though it is much higher than where it was 2 years ago, it's still you're paying a 33 PE to own a 10-year bond. So I think a 16 PE S&P 500 is still a pretty attractive relative value.
I guess my point was that as you continue to see these rising rates and rising treasury yields, then you're going to have people worrying about valuations, especially on tech stocks, which are discounted into the future. And mega cap tech, which I think, Tom, is one of your favorite areas of the market, is under a lot of pressure today.
That's right. For the past year and a half, we've been more on the energy overweight, and we think it's been structurally under-owned camp. But if we can avoid a recession scare and not have a recession, which is, again, our base case, we think from today going forward over the next 6 to 9 months, large cap tech, FANG, are going to really look attractive because, number one, if you're worried about growth, these companies can grow faster than GDP. Their multiples have come in. And I think that from a margin perspective, they're less vulnerable to some of the sort of supply chain and inflationary pressures on labor that are actually hurting other companies. So I think they haven't been great, but we think in the next 6 to 9 months, they could actually be relative outperformers.
So it sounds like the whole view is predicated on the idea that inflation has peaked or is peaking and will come down materially. Do you think the street is just too worried about more long-lasting, higher levels of inflation and what that's going to have to mean for the Fed?
Yes. I mean, we are in a really uncertain transition because we're in the economy's in the middle of a pretty big inflation surge, and now there's supply disruptions associated with the war, and now we have a tight labor market, and now we have a Fed that's become quite hawkish. So I understand why investors are nervous and why everyone's dialed down their constructive views. And I think one of the things that we have to keep in mind is that the market is doing a lot of the work for the Fed. As you point out, rates have already risen. When we look at wealth effect, if you just look at the 4 largest holdings for U.S. households, they're down somewhere between 8 and 15%. That's about 15 trillion of lost household equity. That's already going to slow the economy. We're already seeing gasoline, higher prices affect credit card spending data. So I think in some ways, the Fed, who's talking tough, the market's already doing a lot of the work for the Fed. And if that's true, then we can be a little half full, meaning the Fed may not have to do 9 hikes this year.
So would you buy the cyclical groups as well, Tom, that have really corrected on this notion that the economy is going to slow down, everything from autos to airlines to transports? Or would you stick with the just big tech?
Well, our recommended strategy is beef, which is Bitcoin and Bitcoin equities, energy and resources, which has been a standout, and then FANG, which is large cap tech. I think the cyclicals have gotten pretty reasonably priced because they've been under pressure, a lot of them for more than a year now. And if the supply chain issues are easing, and once China gets through its zero COVID lockdown, which we're not there yet, it is a case for a growth resilience coming. So I think in the first half, it's still a treacherous period. I just would caution any of the viewers not to get too structurally bearish because at the moment, consensus thinks, we're going to have a recession. In fact, we did a Twitter survey, and I think 53% thought the market was going to be down 10% or crash. over the next 6 months. So
well, we did just see the yield curve invert. I know it's uninverted, but that is a classic tell.
Yes, yeah. You don't want to ignore the sign from an inverted yield curve. I mean, it just shows you there's stress, whether it's building in the credit markets or future credit tightening or economic weakness. It's something we have to respect. But fortunately, the curve is steepening again. So it's a short-lived growth scare, hopefully.
Tom Lee, we thank you for coming on and sharing your perspective. It's a little different. Tom Lee from Fundstrat. After the break,